Ever tried making sense of healthcare company reports? It can feel pretty overwhelming, right? Lots of jargon, complex financials.
Definitely, it's a complicated space.
But there's this one company, Oscar Health, trying to shake things up, make healthcare simpler. And the really interesting part, they just hit a major financial turning point.
hmm
So today, we're doing a deep dive into Oscar Health. Ticker is OSCR. They're not your average insurer. They call themselves an Insurtech innovator. We're going to unpack their journey.
Yeah, it's a fascinating story.
Our mission here is to cut through the noise for you, get you the key insights on Oscar, how they're moving towards profit, what's different about their approach, and, the opportunities and hurdles ahead.
Exactly, to give you a really solid handle on where they stand right now.
Okay, let's get into it. Oscar Health. They've hit this major milestone. For years, a lot of these high-growth tech companies, especially in tricky sectors like healthcare, well, profitability was elusive.
Very elusive. High burn rates, focus purely on growth.
Right. But Oscar seems to have made that shift. They've gone from that startup mode to being, well, demonstrably profitable. They actually posted their first full year of net income profit in 2024.
Which is a huge deal.
Yeah.
And they backed it up with strong Q1 results in 2025.
So their main playground is the Affordable Care Act, the ACA individual and family market. That's their core focus. And what sets them apart, apparently, is their tech. They built this whole full-stack platform, basically their own tech from scratch.
Right, owning the entire technology infrastructure and combining that with a really strong focus on the consumer.
Let's look at the recent numbers because they tell a story. 2024 total revenue was, what, over $9 billion?
Yep, $9.2 billion. A 57% jump year over year. Pretty massive growth.
And that didn't slow down much in Q1 25.
Not really. $3.1 billion in Q1 25 revenue. That's up 42% from the year before.
Yeah.
And they netted $275 million in income for the quarter.
Wow. And they're getting more efficient, too. Something about SG&A costs.
Yeah, selling, general, and administrative expenses. Their SG&A ratio hit a record low of 15.8% in Q1. That efficiency boost really helped their operating income jump too, up 60% year over year.
Okay, so achieving that kind of profitability, that net income in healthcare, that's got to be significant, right? Especially for a company that started as this tech disruptor.
Oh, absolutely. It's striking. Doing that in such a complex, heavily regulated field, after years of prioritizing growth above all else, it really validates their whole tech-first model.
So it changes how people see them, investors, maybe.
Definitely. This shift could fundamentally change investor perception. Before, maybe you saw Oscar as more speculative, a pure growth story. Now, with proven profitability, they appeal to a wider range of investors.
Could lead to a re-rating, maybe.
It could. And it might even, set a precedent, show that this tech-driven approach can be profitable in health insurance.
Okay, so how are they actually pulling this off? Let's dig into their strategy, their core value proposition.
Well, they started back in 2012, right? With the explicit goal of disrupting traditional health insurance.
Built on that tech platform we mentioned.
Exactly. That full-stack platform and this real consumer-centric philosophy, trying to put the individual back at the center, give them more choice, more power, designing plans that adapt, as life changes.
And they zeroed in on the ACA market.
Primarily, yes. The individual and family market under the ACA. They have smaller footprints elsewhere, but that's the main focus.
And that market's big.
Huge. The overall U.S. individual market was valued at like $1.6 trillion in 2022, projected to hit $2.5 trillion by 2030.
Wow.
And just the ACA exchange part. Over 24 million people enroll for 2025.
And Oscar's doing well within that market. Better than average.
Seems so. Their enrollment growth has consistently outpaced the market overall. They're gaining share, getting good customer satisfaction scores, and keeping members. Really high retention rates.
Okay, but there's more to their model than just selling insurance plans, right? This dual revenue thing.
Correct. Insurance premiums are the foundation, obviously.
Yeah.
The $9.2 billion in 2024 revenue was mostly premiums, driven by more members, expanding where they operate, keeping people signed up.
Q1 25 followed that pattern.
Largely, yeah. The $3.1 billion was mainly driven by having more members on the books.
But the other part, the Plus Oscar platform, that sounds interesting.
It is interesting. This is where they package up and license out their own technology, their proprietary stack.
To who? Other insurance companies.
Yeah, mainly regional health plans, provider-led plans.
Yeah.
The tech helps automate things like checking eligibility, handling risk adjustment.
Which helps balance costs for sicker patients.
Exactly. And processing claims. It basically lets smaller insurers get some of the efficiencies, the scale, that usually only the big guys have.
Okay, and you said this part is growing fast?
Faster than the insurance premium side, actually. And here's the kicker. These third-party tech contracts, they're driving the majority of their new gross profit.
Really? So it's a diversification play.
Absolutely. A smart strategic move. It helps smooth out the ups and downs you get in pure insurance, which can have tighter margins.
How big is this plus Oscar piece now?
As of early 2024, it was serving over 500,000 lives externally. That's on top of the roughly 1.5 million covered directly by Oscar's own insurance plans.
Gotcha. And they really push the consumer experience too, right? The app, satisfaction scores.
Huge emphasis there. The mobile app gives health insights, reminders, gets good reviews. Their Net Promoter Score, NPS, was 66 in Q1 24, which is quite high for insurance.
Retention.
Impressive. 82% retention for the 2024 open enrollment period. It creates this positive cycle, right?
Right.
Happy members stay, they tell friends. And the providers using the Plus Oscar Tech benefit, which feeds more data back into the system, helping their AI get smarter.
Right, the AI. Let's talk about that. How much is AI really impacting their business? Is it just buzzwords or?
Seems like more than buzzwords here. It looks like a core advantage. They've got AI tools like virtual urgent care. Reports say it cut provider response times by 90%.
90%, wow.
Yeah. They also have something called Care Guide AI. And significantly, automating customer service roles with the AI let them cut about 200 full-time positions.
Which feeds directly into lowering those SG&A costs we talked about.
Exactly. Plus, they're using AI for predictive analytics. Apparently, that's helped cut hospital readmissions by nearly 10%. That saves serious money long-term.
So, connecting the dots, this faster growth from the Plus Oscar Tech platform, plus these big AI-driven cost savings, it sounds like a real strategic shift.
It really does. It points to this successful pivot towards a model that's potentially higher margin, much more scalable. They're moving beyond just being an Insurtech.
To more like a health tech company.
Yeah, I think that's a fair way to put it. Regular insurance can be tough. Low margins needs lots of capital. By selling their tech, they're diversifying, getting value from their innovation.
And these AI gains aren't small tweaks.
No, they seem fundamental, changing the underlying cost structure. And that builds a competitive barrier, you know? It's harder for the big traditional guys to just copy this overnight. It needs deep tech integration, data skills, a different mindset.
Okay, let's circle back to the hard numbers then. The recent financials. Recap the growth.
Sure. Full year 2024, revenue over $9 billion, up 57%. Mainly membership growth, expanding into new areas.
Q1 25 kept it going.
Yep, about $3 billion revenue, up 42%. Again, driven mostly by higher membership. They had around 2 million members total as of March 31st, 2025. That membership growth significantly outpaced the industry average.
And bottom line, profitability.
That first profitable year in 2024 was key. Then Q1 25, net income hit over $275 million. Big improvement from Q1 24.
Earnings per share looked good too.
Yeah, 92 cents for Q1 25, up from 62 cents the year before. Operating earnings up strongly. Adjusted EBITDA up led to that operating margin of almost 10% in Q1.
Okay, what about that medical loss ratio, the MLR? How much goes to actual medical care?
Q1 25 was 75.4%, which looks pretty good on the surface.
But there's a catch.
Well, a couple of things. That number included an unfavorable adjustment from a prior year. And critically, Q1 MLRs often look lower because new members join, pay premiums, but haven't had much time to actually use healthcare services and rack up claims.
So costs might climb later in the year?
It's typical. Oscar usually targets a full-year MLR somewhere in the 80–82% range. So while 75.4% is good for Q1, you expect it to trend up.
That makes sense. So managing that MLR is crucial.
Absolutely. That's a really important point. While the Q1 MLR looks favorable, that first quarter effect is real. Later quarters could definitely see higher claims, pushing it toward their annual target.
So while the SG&A savings seem more permanent, driven by tech and scale...
Right, those seem more structural, more sustainable. The MLR is the piece that needs constant vigilance quarter after quarter. Managing those two ratios, effectively MLR and SG&A, that's really going to dictate how fast and how far their margins can expand going forward.
Okay. And speaking of SG&A, that drop to 15.8% in Q1 25 was significant.
Very. Driven by leveraging fixed costs better as they grow, lower fees they pay to exchanges, and just general cost discipline.
And the AI automation played a big role there too, right?
Yeah, they attributed a big chunk of the improvement in 2024, like 520 basis points, directly to AI-driven automation. That suggests it's a real, lasting efficiency gain.
What about their cash position? Balance sheet?
Looks pretty solid. Almost $5 billion in cash and investments. and their free cash flow picture has improved dramatically.
How so?
Well, they went from burning cash in 2023 to generating strong positive free cash flow in 2024, like $4.43 per share.
Yeah.
A massive turnaround. And they project generating $275 million in free cash flow in 2025.
Okay, so financially, they seem to be on much firmer ground. What's the plan looking ahead? They can't just sit back now.
No, definitely not. They have pretty ambitious expansion plans, aiming to be in 150 new metro areas by 2027.
150. Wow.
Yeah. For 2025, they're already in over 500 markets across 18 states. That's clearly helping drive that fast revenue growth.
And technology, AI, that stays central.
Absolutely. It's core to everything. Digital first experience for members, AI routing care, simplifying costs. We saw the results that 90% faster response time for virtual urgent care, nearly 30% efficiency boost there.
The lower hospital readmissions?
Right, almost 10% reduction thanks to AI.
Yep.
That directly saves medical costs. This tech capability is really what enables their growth, their efficiency, and helps keep members happy.
Okay, now this other thing, ICHRA, individual coverage health reimbursement arrangements. You mentioned this is a big future focus.
Yes, this looks like a really substantial strategic growth opportunity for them. It lets them reach beyond the regular ACA market.
Who are they targeting?
Small and medium-sized businesses. Think companies with fewer than 1,000 employees. There are about 75 million Americans working in that segment.
And what's the appeal of ICHRA for employers and employees?
For employers, it offers cost stability. Instead of managing a group plan, they give employees a defined amount of money, a contribution to go buy their own plan on the ACA market. It shifts the risk.
And for employees?
More choice, more flexibility. They can pick the plan that best suits them from the individual market options.
So OSCR wants to be a major player here.
Exactly. They're launching new ICHRA-specific products in 2025, planning to scale it up significantly through 2027. And the market itself is expected to grow fast, maybe 15–20% a year through 2030. Huge potential.
So connecting this back, ICHRA isn't just about finding new customers.
No, if we connect this to the bigger picture, aggressively pursuing ICHRA is a critical strategic move for diversification and, frankly, de-risking.
De-risking from what?
From that looming expiration of the enhanced ACA subsidies in early 2026. Remember those?
Right, the extra help making ACA plans affordable, if that goes away.
It could definitely impact enrollment and retention in their core individual market. So by building up this ICHRA business, OSCR creates a significant new revenue stream that's less dependent on those political decisions about subsidies.
So to hedge against that risk.
A proactive countermeasure. They're tapping into this large group of employers and employees looking for different solutions. If they succeed in scaling ICHRA, it could really strengthen their overall business resilience against policy changes or shifts in the traditional ACA exchange.
Makes sense. What about other new products? Anything else innovative?
Yeah, they're working on multi-condition plans. These are specifically designed for people with chronic conditions, diabetes, lung issues, heart problems.
How do those help?
The idea is coordinated, comprehensive care. They project these could lower total health care costs by 25% or more. Features like $0 specialist visits, caps on insulin costs.
And they're also doing something for Spanish speakers.
Right. Buena Salud, a Spanish-first insurance product launching in 2025. It builds on an earlier initiative called Hola OSCR, which apparently did really well in Georgia, high growth, great retention, really high satisfaction scores. So they're trying to better serve non-English speaking communities.
So looking out longer term, what are their financial goals, projections?
They're targeting around 20% compound annual revenue growth through 2027.
Pretty ambitious.
It is. And an operating margin of about 5% by 2027. Importantly, they say that target holds even if the enhanced ACA subsidies don't get extended.
Okay. And earnings per share?
Projected to exceed $2.25 by 2027? That's a pretty significant number compared to where they are now.
All right, let's shift gears to valuation. How is the market pricing all this in? What does that PE ratio tell us?
Okay, so as of early July 2025, the stock's around $16, $17. Market cap about $5.2 billion.
And the PE, price to earnings?
The trailing 12 months PE is somewhere in the low 30s, maybe 32 to 34 times earnings, based on their earnings up to March 2025.
Has it always been around there?
Oh no, it's been volatile.
Yeah.
It was much higher, sky high really, at the end of 2024. And before that, when they were losing money, the PE was negative.
So low 30s now. Is that high or low compared to others?
It's definitely high compared to the big established insurers.
Yeah.
United Health, UNH, trades at a PE around 12 or 13.
Wow, big difference.
Yeah. Equitable, EQH, which gets mentioned sometimes, is around 14 or 15 times earnings. even though it has higher profits and margins than Oscar currently. Principal Financial, PFG, also lower, maybe mid-teens to 20s.
So Oscar's PE stands out.
It does. Typically a PE over 30, or a negative one, signals a growth stock. And Oscar, with that positive PE now, plus those aggressive growth forecasts, 20% revenue CGR, EPS over $2.25 by 2027, fits squarely in that category.
What does that high PE really signal then? What's the market saying?
Well, this substantial premium baked into Oscar's PE clearly signals that the market is placing considerable value on its future growth potential, on its disruptive tech strategy.
So investors are paying more now for expected future earnings.
Exactly. They're willing to pay a much higher price for each dollar of current earnings because they anticipate a much steeper ramp-up in future profits. But
There's always a but.
there is. That high valuation makes the stock inherently more sensitive. If there's any bad news, if they miss targets, the reaction could be stronger because so much expectation is built into the price.
Which explains why some analysts are cautious.
Right. You see contrasting views. Some worry about valuation sustainability, others call it a screaming bargain. It highlights that classic risk-reward trade-off for growth stocks.
Okay, but it's not all potential upside. What are the actual risks, the challenges they face?
Well, the biggest near-term one is definitely regulatory. That scheduled expiration of the enhanced ACA subsidies in January 2026.
They keep coming back to that.
Because it's crucial. Those subsidies help 24 million people afford coverage. If they're not extended, and politics are always unpredictable, it could definitely dampen Oscar's membership growth or cause more people to drop coverage.
So a direct hit to their main market.
Potentially, yes. And just generally, healthcare is super regulated, always changing. Staying compliant takes a lot of effort and money. On the flip side, some proposed government rules around program integrity might actually help Oscar.
So it cuts both ways.
It often does in healthcare regulation. But that ACA subsidy question looms large.
And this brings us back to ICHRA and the Plus Oscar platform again, doesn't it?
It really does. This raises that important question again. How effectively can Oscar's strategic push into the tech platform, and especially into the ICHRA market, act as that counterweight, as that buffer against the ACA subsidy risk? The success of those diversification efforts really feels paramount right now.
What about operational risks, things going wrong internally?
Sure. That medical loss ratio, the MLR, it can be volatile. Unexpected spikes in medical costs can squeeze margins. We talked about Q1 looking good, but needing that full-year perspective.
Because claims could rise later.
Exactly. Trending towards that 82% target. And member churn is always a risk. If enrollment rules change, or competitors get more aggressive, or people just aren't happy, high turnover hurts revenue and costs more to acquire new members.
Competition sounds fierce, too.
It's intense. You got the huge incumbents, United Health, Humana, etc., and then maybe 125 other active Insurtechs trying different angles.
Could the big guys just copy Oscar's tech?
They can certainly try. They have deep pockets. But replicating that integrated tech stack and the company culture around it isn't easy. Still, there's constant pressure on price, on service, on innovation.
It's just execution risk.
Doing what they say they'll do.
Always a factor with ambitious plans. Expanding to 150 new metros, scaling up ICHRA nationwide. That takes flawless execution. Managing partnerships, launching products smoothly, keeping service quality high as you grow. It's challenging.
So who are these other players? Who are they really competing against? You mentioned other Insurtechs.
Yeah, quite a few. Devoted Health is one, founded 2017. They focus on Medicare Advantage, mixed virtual and in-home care. Tech, they've raised a lot of money, high valuation.
Okay.
Clover Health is another, also big in Medicare Advantage. They had a strong Q1 25, actually. Good revenue and membership growth, improving profitability. They also push a tech-first approach to managing care.
Anyone else notable? Bright Health. Bright Healthcare. Well, their stock isn't listed on the NYSE anymore. They aim to integrate local healthcare systems. But recent financials showed losses and declining value. Seems like they hit some major operational hurdles.
Gotcha. And the traditional giants?
They still dominate. The top 5 control roughly half the U.S. market.
Yeah.
United Health Group, UNH, is the biggest. Huge revenue, huge market cap. They run United Healthcare for insurance and Optum for services.
And their PE is more lower, like 12.6.
Right. Reflects a more mature, slower growth profile. Humana, HUM, is another major player. They had a tough Q4 24 loss, but maintained their 2025 outlook. They are expecting fewer Medicare Advantage members this year as they exit some unprofitable plans.
And Equitable. EQH, you mentioned them with the PE comparison.
Yeah, they're more of a broad financial services company, but sometimes get grouped in. They actually have higher revenue and earnings than OSCR right now, and much better margins and return on equity.
But a lower PE.
But a lower PE, around 14-15. Shows how the market values Oscar's growth potential more highly, despite Equitable's currently stronger profitability metrics.
Okay, that's a lot of ground covered. So, bringing it all together, what's the takeaway for someone trying to understand Oscar Health right now?
Well, to sum it up, Oscar Health really is at a critical juncture, wouldn't you say? That shift to consistent profitability in 2024 and early 2025, it's not trivial. It shows their model is maturing, their strategy of using tech for efficiency and growth is working.
Key strengths being the rapid growth, outpacing the market.
Right. That strong revenue and membership growth, the dual revenue stream with the Plus Oscar Tech platform growing really fast and boosting profits, and the deep AI integration, cutting costs and improving care.
But it's priced like a growth stock.
Exactly. That PE in the low 30s reflects high market expectations for the future, which means potential upside, but also sensitivity if they stumble.
And those strategic moves, like ICHRA.
They seem crucial for resilience, not just growth for growth's sake, but strategically de-risking the business from things like that potential ACA subsidy expiration.
So the big question for you, the listener.
Yeah, it really raises this important question for you to think about. When you look at Oscar Health, this unique mix of tech innovation, consumer focus, and now a proven path to profit, how do you weigh that significant potential upside against those very real industry risks, especially as they shoot for that 5% operating margin and over $2.25 in EPS by 2027?
That's definitely a lot to chew on. But hopefully you have a much clearer picture now of Oscar Health, its journey, and where it fits in this constantly changing healthcare world. It's really a prime example, isn't it, how tech is disrupting even the most established industries.
A fascinating case study.
So here's a final thought to leave you with. As you consider Oscar's path, think about this. If their AI keeps driving these kinds of efficiencies, improving operations at this rate, could they actually change the definition of profitability for health insurance? Could they force the traditional giants to fundamentally adapt or risk getting left behind?